AMC Theaters has been an innovator in the movie theater business for more than 50 years. Retail investors are pouring into AMC Entertainment Holdings as part of the market-wide attempt to trigger short squeezes, which is what happens when a chain reaction of short covering action causes an equity price to skyrocket. The rally has sent AMC stock up 525% year to date, but those who currently own shares in this movie theater operator should consider jumping ship. AMC faces massive losses and a potentially broken business model. The stock price bubble could pop at any time soon. Some who think they missed their chances to take advantage of the GameStop jump are considering investing in AMC because they think there is still some upside to take advantage of. Hey, what's up guys? Welcome to Investors Game. In this video, we're gonna be talking about why you shouldn't buy AMC stock. And if you guys wanna see any more investing tips, stocks, method, and strategy from me in the future, then be sure to subscribe down below. Turn on my post notifications so you never miss another upload. And now let's jump right into the video. For those who don't know AMC Entertainment Holdings is an American movie theater chain headquartered in Leadwood, Kansas, and is the largest movie theater chain in the world, founded in 1920. AMC has the largest share of the US theater market, ahead of Regal and Cinemark theaters. In other words, it's the biggest theater cinema in the world. Stocks like AMC and GameStop may look appealing because their share have soared so high in such a short amount of time, but that volatility is actually a red flag for most investors. Normally, healthy companies will see slow but consistently increasing share price over time. When any company experiences an extreme stock price jump, most of the case, news can have a big impact in the stock. If there's no real corporate news involved, it often means something isn't right. A big jump in price is especially worrisome when it involves a company that has been struggling financially. AMC Entertainment has taken a major hit to its operation over the past year, and it's only narrowing avoided bankruptcy at the moment. AMC will need to show some healthy financial to manage the increased debt it has taken on to remain in operation to this point. Robinhood and several brokers continue to impose trading limitation on AMC and other stocks due to surging volatility. It's clear the demand that caused share to triple in just the last week continues as this trading week begins. Now the company is considering selling even more stocks to take advantage of the sudden spike. But investors should remember that even as the share price has skyrocketed, the business is still in a terrible position. Even if AMC outlives the crash, its stock isn't necessarily a good investment for equity holders, who will face substantial dilution and a higher debt load. These factors will be a long-term drag on earnings per share and cash flow because of a higher number of shares outstanding, interest expense, and debt amortization. More importantly, the movie theater business may never return to its former glory. The industry was already in decline, with box office sales falling a compound annual growth rate of negative 1.4% from 2002 to 2019. And the past crash may have accelerated this trend by encouraging studios to build up their streaming platforms. AMC had an average of 107 million shares outstanding. By the end of October, that had reached 137 million, and since then, the company has sold about 260 million new shares to avoid bankruptcy, bringing its shares outstanding to approximately 4 million shares. In other words, shareholders who have held their position over the last 6 months now own just 1/4 of what they did in the third quarter. Even before the crash, AMC has drawn in debt. The company finished 2019 with $4.7 billion in corporate borrowings and just $265 million in cash. At the end of the third quarter, that debt increased to $5.8 billion. A company that is increasing their debt and a number of shares outstanding may be a sign for you that it's a bad company to invest. What we're trying to look is for companies that have a strong balance sheet, a small debt, and a good annual growth rate. But AMC has run into a big debt, has a weak balance sheet, and a negative annual growth rate. AMC burned an average of $124 billion in cash in each of the last 3 months of 2020, or nearly $400 million for the quarter. The first quarter is likely to see a similar cash burn rate as well. In the US, where most of the AMC theaters are, overall movie ticket sales peaked in 2002 at 1.58 billion tickets sold. In 2019, before the crash hit, it was 1.23 billion tickets sold. And that's even as the US population increased by about 50% from 2002 to 2019. Movie theater haven't innovated much, and there are many more entertainment options than there once were, including mobile devices and gaming, social media, and video streaming. Meanwhile, other companies connected to AMC business, like malls, are also on the decline. The entire mall ecosystem, including movie theaters, is getting crushed by the crash, and it will be difficult for it to fully recover. When investors start hyping a stock, it is difficult to remove emotion from the equation, but that is what required to save yourself from a heart attack and big losses. Apart from holiday season, GameStop comps and profitability have been faltering. After all, activist investors typically don't get involved if everything is going well. Investing is a serious business, but this has the classic underpinnings of people playing a game that is going to end badly. To avoid getting burned, this is one stock you shouldn't play around with right now. Regardless of whether AMC can overcome its financial struggles, it's still best for most investors to avoid the stock right now. Its price has been manipulated by only traders, and as soon as those traders decide to move on to another stock, AMC's share price will crash. It is important to remember one of the golden rules of investing. If it looks too good to be true, it probably is. All investors have an emotional reaction to market swings and decisions to turn out differently than expected. But you cannot get rid of those emotions any more than you can eliminate market volatility. But you can implement practices that'll help you to stay more level-headed and processes-oriented. Even when the market's going haywire, with a neutral mindset, you make better decisions and very likely more money too. Investing without emotion is easier said than done, but there are some important considerations that can keep an individual investor from chasing futile gains or overselling in panic. Understanding your own risk tolerance and the risk of your investment can be an important basis for rational decision. Active understanding of the market and what forces are driving bullish and bearish trend is vital as well. Overall, while there are times when active and emotional investing can be profitable, data shows that following a well-defined investing strategy and staying the course through market volatility often result in the best long-term performance returns. If you like this video, don't forget to hit the like button. Let me know in the comment box, would you invest in AMC stock? Subscribe to my channel because every week I'm doing new content, and do not forget to activate the bell so you don't miss any of our videos. See you next time.